Wow, we're spending quite a bit of time on the second page of Form 1040. Lots of time on deductions, taxes, and now credits. Welcome to video T14F. Individual credits have become an important part of the individual tax code. One reason is that we're going to see a credit benefits all taxpayers equally, whereas a deduction benefits high-rate taxpayers more. Anyway, let's get started. First, let's remind ourselves of the overview computation. We're focused on step 6 in this video. Recall that non-refundable credits are reported on line 12, and refundable credits are reported on line 17. And that each of these pull from supplemental schedules. For example, line 12 taps into Schedule 3, and the handful of non-refundable credits listed here. And line 17 gets some credits from Schedule 5. Before digging in on the tax law associated with individual credits, let's remind ourselves on the difference between a deduction and a credit. Take itemized deductions or the standard deduction, whichever the taxpayer uses. These both serve to decrease taxable income. By doing so, the tax base is lower, and rate times base is tax, so tax is lower. A credit works a little differently. It serves to reduce the actual tax itself. It does not factor into the calculation of the tax base, but is a dollar-for-dollar reduction in the tax amount itself. Generally, a credit would be preferred to a deduction. Let's look at some examples. We'll start with a low-rate taxpayer. In this example, a 10% rate. We're comparing two taxpayers, one with a $3,000 deduction and the other one with no deduction. Let's look. I've shown the calculation of tax for both, and it should come as no surprise that the taxpayer with the deduction has a lower tax, $700 instead of $1,000, for a tax savings of $300. For those of you that really love the after-tax formula from Module 5, you know we could have just used 3,000 times 10% to derive the tax savings from the deduction. Now let's compare that to a high-rate 37% taxpayer with the same 3,000 deduction. It should come as no surprise that the high-rate taxpayer saves 3,000 times 37%, or $1,110, from the same $3,000 deduction. Okay, so now we can see that the tax rate of the taxpayer has an effect on the value of a deduction. So let's consider our old ability to pay variable as part of a good tax. And let's say that Congress has decided that having kids puts a greater value on the marginal utility of income. For those of you with kids, you know what I'm talking about here. As a result, Congress says all taxpayers will receive a $3,000 deduction for each child. Okay, now you ask yourself, does it cost more to provide a child with necessities if you are rich than if you are poor? Typically, the answer would be no. Food, clothing, shelter. As necessities, it's going to cost a high-income taxpayer about the same as a low-income taxpayer. But our deduction has a very different value. It was worth $300 to the low-income taxpayer, but over $1,000 to the high-income taxpayer. Under the ability to pay principle, that doesn't seem fair. As a result, a child tax credit was implemented. If a low-rate taxpayer and a high-rate taxpayer both receive a $3,000 credit, the value is the same, $3,000. Another reason credits are used is that many of them are a way of making a welfare transfer back to a citizen based on levels of income. Although the tax system is by design intended to collect revenue for the government, it also provides a convenient time for individuals to report the amount of income they earned in a year. If we would like welfare transfers or the social safety net to be based on need, income taxes provide an ideal opportunity. And as a result, a number of income tax credits are geared towards low-income households. Many others are designed to benefit those in need. Remember, ability to pay is an overarching factor. As a result, high-income taxpayers may find themselves ineligible for certain credits. As an example, does Bill Gates need the government's help to send his kids to college? Probably not. We are going to spend some time here shortly working through the way in which many credits and deductions are limited by income through something called a phase-out. So get ready. We'll start with the child tax credit. The credit was subject to a pretty significant change in the new tax law in late 2017. The credit amount is now $2,000 per child. But perhaps more important to many taxpayers is the increase in the phase-out. For those of you that lean left politically, this was not entirely a giveaway to the rich. First, from a fairness perspective, we just discussed that raising a child pretty much costs the same regardless of your individual wealth, although we could debate that. And also, the phase-out of the child tax credit at $110,000, which was the old 2017 limit, that was set in 1998. That's 20 years ago, and it's never been adjusted for inflation. Now, I'm not about to argue that $110,000 in 1998 is worth $400,000 in 2018. After all, that would have been 6.6% inflation each year, but certainly some adjustment was due. Okay, I mentioned we were going to work through a phase-out, and here we are. This will be your first, but definitely not your last. We'll use the 2018 limits to compute our phase-out. Phase-outs prevent taxpayers from falling off a cliff. A and B have income of $400,000 and thus are just at the threshold and are entitled to a $4,000 child tax credit. That's $2,000 times their 2 kids. C and D have income of $400,000 and $1. That's just $1 more than the threshold. And in this hypothetical example, would not be eligible for the child tax credit and would only get 0. Well, that doesn't seem fair and certainly places a very high marginal tax rate on that $1. As a result, the credit does not fall off a cliff, but rather phases out or is decreased ratably as income goes over the threshold. This gradual phase out means that the $4,000 does not go directly to 0, but would decrease as income increases over $400,000. The child tax credit phases out $50 for every $1,000 or part thereof over the limit. If the taxpayers had income of $402,235, they are $2,235 over the limit. We divide that by 1,000 and get 2.23, which is rounded up because it's every part of 1,000 to 3. 3 times 50 is 150. Thus, the maximum child tax credit is $4,000, which was the total minus the 150 phase out, or $3,850. This functions a little differently than the floor that we noticed for itemized deductions. This chart shows how the child tax credit under 2018 law would phase out. I want to draw your attention in particular to columns A and D. Recall the rule said $50 for every $1,000 or part thereof. That there or part thereof language means that even $1 over the 1,000 counts as a whole 1,000. Thus in column A, income over the threshold of $1, an entire $50 is lost from the credit. In column D, 7,201 rounds up to 8 because the 201 is another part of the next 1,000. Basically, think of it as the rounding rule for this phase out is always round up. You can see that the amount of the child tax credit depends on both income and the number of children. For example, a married filing joint taxpayer with 1 child, the child tax credit is completely phased out at $440,000. However, you can see in the last column of this chart that isn't true if the credit can be claimed on more than one child. Okay, now we've worked through our first phase out, let's do some more credits. The dependent care credit is available to taxpayers to help cover the cost of care for a dependent while they work. The credit amount is $3,000 per dependent, but never more than $6,000 for 2 or more dependents. I guess having more than 2 kids is un-American? Well, anyway, the credit can never be more than the earned income of the taxpayer or the spouse if married. This ensures that the need for the care is based upon having to work, and not so a stay-at-home mom or dad can play tennis with their friends that afternoon. This credit is also subject to a phase-out. So this credit has become a bit complicated. So unlike the child tax credit, for which the IRS offers a worksheet in the instructions, the dependent care credit uses a Form 2441. Let's walk through the form briefly. Line 3 is going to be the total of costs spent on care for dependents. I truncated lines 1 and 2 for space, but you list the care provider, the tax ID number for the dependent, and the tax ID number for the care provider and whatever cost you incur. Note that line 3 caps the amount at $3,000 per dependent and never more than $6,000 total. Line 4 requires entry of earned income, and line 5 captures the same for a spouse if there is one. Then line 6 limits the credit to the smallest of those 3 amounts, which is the $3,000 per dependent or earned income. Next, the taxpayer's AGI is used on line 7 to determine the phase-out percentages shown. You can see that the lowest credit amount is never less than 20%, so pretty much everyone gets some amount of dependent care credit. Let's take a moment to read this example. The credit is initially set at $3,000 for the 4-year-old and $1,600 for the 6-year-old. The excess cost for the 4-year-old cannot be shifted to the 6-year-old. Both taxpayers have earned income in excess of those credit amounts. And so we just need to apply the phase-out provided on the form. $920 of dependent credit against $13,600 of cost. Well, I guess every little bit helps. Most tax credits are limited to the amount of tax liability. For example, a taxpayer with very low income may have very low tax liability. Bill has income of only $9,000, and his income tax is only $900. In 2018, he was eligible for a $1,000 dependent care credit. He can only take a $900 credit to zero out his liability. This is called a non-refundable credit. Some credits, however, are refundable. For example, the child tax credit, under both the old and new law, has a portion that's refundable. If Bill had been claiming a $1,000 child credit, he would actually be eligible to receive a $100 refund, in essence, a negative tax. Our next credit is the earned income credit. Recall that employment taxes are generally considered regressive. Even a low-income taxpayer will pay employment taxes, or sometimes known as FICA taxes. The earned income credit is one of the credits designed to give back employment taxes for low-income taxpayers, and is a welfare program inside our tax system. Remember that I mentioned that income tax filing is a convenient time to cross-examine income against need, and thus the earned income tax credit was born. The earned income credit is designed to require earned income to justify the credit, which means by default, the expectation is that the taxpayer is working to generate earned income. The earned income tax credit has many requirements and is far too complicated for most of the taxpayers it's designed to service. The requirements are even beyond the scope of this course, but you should note that the EITC is a refundable credit. Because of this, the requirements should be fairly strict. Paid tax preparers that prepare tax returns for a client claiming an EITC are required to complete due diligence paperwork to show they have considered the necessary qualifications. Taxpayers can also request that the IRS prepare the Earned Income Tax Credit calculation for them. And lastly, there is an EITC calculator on the IRS website that walks a taxpayer through all of the qualifications and input to properly calculate the EITC. You can see in the analysis of taxpayers claiming the EITC that this is a tax benefit that is heavily weighted into the lower income tax brackets. I think the contrast between the child tax credit, which is available to many taxpayers across the income distribution, and the EITC, which is available only to low-income taxpayers, is an interesting contrast in tax policy. The result, as shown in the final column of this table, is that many lower-income taxpayers have a negative income tax. They actually receive money as a function of filing taxes. This is not a refund amount. That's just settling up over and under payments. These folks earn federal transfers as a result of filing taxes. Before we leave this slide, I want to note the number of returns filed in each of these brackets, which don't match up with the income brackets, but that's okay. There were over 174 million tax filing households in the U.S. in 2016, which is what this date is for. About 45% of those households have income of under $40,000. In what I can only describe as incentive to all of you, the average salary for a student with a college degree in business is $45,000. In your first year, on the average, you are going to be doing better than 45% of all U.S. households. That should make you feel pretty good. Let's visit employment taxes again. First, recall that an employee has employment taxes withheld from a pay at the rate of 7.65%, but that is actually two taxes, a 6.2% tax for Social Security and a 1.45% tax for Medicare. Recall also that Social Security tax is 6.2%, but only up to a cap. In 2018, that cap is $128,400. The 1.45% Medicare tax has no such cap. Okay, armed with that information, let's review Kana's situation. Kana had two jobs during 2018. Her first job paid her $60,000, and her second job paid her $70,000. Both employers will have withheld 7.65% all year, and thus withheld 6.2% on a total of $130,000. As a result, Kana has overpaid Social Security tax. The Social Security Administration does not run a refund operation, but instead permits taxpayers a credit for the amount of overpaid Social Security tax. As a result, Kana will record a Social Security overpayment credit on her income taxes. Although technically not a credit, the alternative minimum tax sits in the section of the Form 1040, so we'll cover it now. The AMT is an alternative tax that requires a taxpayer to compute an alternative tax base and apply an alternative tax rate. You then compare the AMT to the regular tax, and you are required to pay the higher amount. Mostly, AMT forces a new tax base with fewer deductions. Note that AMT for corporations was repealed with the new tax law, but AMT for individuals was not and is still in full force. The good news? AMT is beyond the scope of this course, so we're done. And when I say done, I mean done. This is the end of video T14F. We only have one more Chapter 14 video, and then we switch to Chapter 6 to start covering business taxation. As always, thanks for watching.